Welcome, everybody, to our Modern Retail Plus talks. Investing and VCs have been a sort of integral part of the direct-to-consumer landscape over the last few years. Investors have absolutely poured money into direct-to-consumer startups, especially in retail. And it really sort of, a lot of people talk about kind of the grandfather of DTC with Warby Parker, but the number of deals have been growing on almost exponentially. And you see almost after 2016 how that growth really went up. And if you go to the next slide, what I found really interesting is sort of how funding by category has been. This is from last year's numbers, and the funding has been sort of in a bunch of different places. You can see a lot more emphasis placed on health and beauty, apparel, and I'm excited to hear from Matt a little bit to talk about this as well and how this is going to change moving forward, as a lot of these brands are heavily reliant on physical retail rather than just being completely online. So if we look at the next slides, even pre-coronavirus, which I find really interesting, sort of the direct-to-consumer plus VC calculus was changing a lot. We wrote on Modern Retail, Cale Weissman wrote a great story before this whole outbreak really sort of hit the US. And we talked a lot about how sort of startup style valuations and expectations were being applied to a lot of retail companies. And those often, I think a lot of people are finding out, and I know Matt and I have talked about this before, really just did not work. I remember talking to a bunch of retail founders that were saying that the sort of expectations of growth that a lot of VC firms, a lot of investors were expecting from them early last year, so early 2019, were absolutely bonkers. There were just things that would not work. And a lot of them caused a lot of them to spend a lot more money on customer acquisition. So you saw customer acquisition costs increasing, going through the roof. And the early sort of days when a lot of these startups were able to capitalize on cheaper customer acquisition costs on Facebook and Google and Instagram had sort of gone away. And I know that everyone's probably sick and tired of hearing that word CAC is the new rent, but that definitely was happening before all of this. Margins got thinner. And when you saw sort of on the IPO market, it was brands like Casper fizzled. And we were talking a lot about at Modern Retail about how the IPO market and sort of Casper was seen as this bellwether for what would happen to the direct-to-consumer retail landscape and the financial performance of these companies. And it was seen as a bellwether. And for a lot of people after Casper's IPO, a lot of sort of reality came to this business. And for founders too, they started realizing there may be other paths. VC had become this integral part of this landscape, that we should always take a lot of money. We should take money constantly. And a lot of people said, maybe I don't want to build the $100 million, $200 million, $500 million company. Maybe there's benefit in building a healthy $20 million business that doesn't rely as much on funding. So if you go to the next slide, the thing that we sort of kept hearing pre-coronavirus was these 3 Ps: that focus on profitability, have prudence when it comes to growth, but also in who you're partnering with, and patience. And you're seeing this from both the investors as well as the founders of a lot of these companies. And now, obviously, these become even more and more important. So this calculus, which was already changing, has upended. One thing that, we've seen as sort of the state of the industry is that VC funding isn't dead for retail startups. It's just very, very different. And raising money during this environment may be difficult, if not impossible. But what does that really mean? And what can you do instead? So, I'm going to kick it over to Matt, but the things that I'm hoping that you're going to learn from this talk is really going to be focused on what founders should be looking at right now, how to cut costs, and how to think about future-proofing their business in a way that makes sense in this new reality. So Matt's going to take it off for now. If you have questions, of course, please do use the Q&A tab at the bottom. We'll be answering questions throughout our conversation. And now I'm going to bring up Matt Higgins. Matt is a wonderful person, firstly, and we were just talking about some of the great lessons that he's been detailing about this whole pandemic on LinkedIn, and some of them have been sort of really exciting to talk about, sort of what he's learned from this entire thing. He's an entrepreneur, he's an investor, and really he's an operator. He's the co-founder, of course, of RSE Ventures, which is focused on companies that are mostly being across sports and entertainment, changing in the last few months as well, which I'm hoping we're talking about. He's, of course, also a recurring shark on Shark Tank, where you may have seen him. So Matt, take it away.
All right. Thanks for having me. And I am excited and fired up, mostly because I just love getting into the trenches with founders and operators, and especially during hard times, right? Because that's where we all kind of lean in together. And something that our country isn't doing enough of, which is trying to draw the best practices from everyone else, right? This is, if ever there was a time to crowdsource solutions, the time is now, because we are all dealing with exactly the same problems. So I just want to start here because I think it's so important to ask yourself the right question. I found this with a lot of companies in my portfolio. The first instinct, which was the right one, which is survival. How do I extend the runway? Like, it's not about profitability. It's not about anything else but buying time so that we can come out the other side of it. So the first mandate was obviously survival. But the second thing I found, there was a degree of like what I call like the Independence Day impulse. And if you haven't seen the movie, see it out, you see what I'm talking about. Like, we will rebuild stronger than before. And some of my concepts, especially around retail, were rushing to emulate the world as it was before COVID. And I think in some respects that's not the right question to be asking. The right question to be asked is, if I were launching my business today, what business would I build? Because if you move too quickly and you don't reassess your conditions, you end up building a replica of what could end up being a relic pretty quickly. So to give kind of a specific case study, one of my businesses is very heavy on brick and mortar, but over time, and this wasn't in the original pitch deck, like a pretty significant DTC and then ultimately CPG play developed, and had actually moved from being kind of the sideshow to potentially the main event. Well, COVID gave us an opportunity to reassess. All right, for the time being, brick and mortar is obviously shattered and shuttered, but the DTC business is skyrocketing. Our CAC has gone down dramatically. CPG is actually taking off. Maybe we shouldn't be looking to rebuild all these stores. Maybe we should be. We shouldn't. And I know a lot of us personally and professionally are going through that same reappraisal. Maybe working from home isn't as unproductive as I once thought, and we could touch more into those details. So my only point is, I think if you don't ask the right question, you're destined to get the wrong answer. So it's important you ask yourself, if I'm building my business today, what business would I build? We'll go to the next one. So I want to spend a little bit of time. I think everyone on this call probably has seen some version of this slide, but I want to take you back to a course that I co-taught with Len Schlesinger at Harvard Business School. It's amazing. Just in January, it feels like it was 5 years ago. But the course is called Moving Beyond DTC. And the purpose was to look at the DTC space from every angle and reassess what had changed from 2010 to 2020. And I felt like no one had taken a truly comprehensive view of how the industry had evolved since Warby Parker. And there were certain sort of old assumptions that needed to be updated. But to sort of level set, I think this slide is fascinating, right? From 1923 to 1983, all these brands basically had, all the market share. And then, of course, the internet, opens up an entire revolution. Next slide. Um, and so, so what happened, right? The drivers, of course, were, e-commerce and the ability to have unlimited access, social media, the ability to have a one-to-one conversation, access to information, and the fact that, basically you had pricing transparency. And then you had the ability to have this rapid product iteration, this feedback loop. Those four factors and many others birthed, the Warby Parker, right? Like to what you just said before, the grandfather, of DTC. Next slide. And then a lot of it was just built on supply chains and the ability to go ahead and create efficiencies and borrowed supply chains. Didn't have to become vertically integrated back then. It would be cheaper and faster and lower barriers to entry. And basically anybody with a business plan at Harvard or Wharton with a pretty good idea, could get traction. And all of it was always predicated on the ability to have a one-to-one conversation with a customer. I think that is and remains what makes a DTC so unique, is that it's not so much, a vertical in an industry, it's a launch vertical, but what makes it different is that you can have these intimate conversations that you could never have with a customer if you had to rely on a middleman, right? That you can, would Hims really have ever gotten off the ground if they had felt like they needed to launch in Target? Probably not. I mean, so you can't separate the marketing and the message and the conversation from the company, right? Hims took a taboo topic and was able to build a community around a taboo topic by destigmatizing it, basically taking a product that was off patent and going ahead and launching a company, which, is now a multi-billion-dollar company. But if you sort of strip out what's novel about that, it's the ability to have that one-to-one intimate conversation, bypass the middleman, and basically launch. I think where we kind of went astray is that works, and I'll cover this in the next slide in a second, but uh, at the end of the day, you got to quickly evolve beyond DTC if you're going to thrive. So next slide, which I love this slide. So this basically comes, I'm stealing Ben Lair's idea. So if anybody works at Lair Hippo, I want to disclose that Ben and I worked really hard with Stephen Reiser on my team to prepare this, to set the stage for this Harvard course, which was 4 days, 22 classes, 29 speakers, but began with sort of setting the stage about where we were in 2010 and where we are in 2020. So I'm not going to break down everything, but I think, one by one market dynamics, I think the most important part, back then, the very idea of DTC was very novel, and you just needed a business plan. There was unlimited supply of VC capital, and the focus was on growth, right? Kind of the 2010 version of the 1990s idea of mindshare, except here was just about growth. And as long as you showed that growth, you could sustain ever increasing valuations. Fast forward to 2020, like omni-channel is not something that you put on the 7th page of your deck. Omni-channel has to be visible and telegraphed and forecasted at the beginning. And the reason why, and we can get this in retail, is because of the 2015 study at MIT that shows having a physical touch point in the world for a DTC is going to dramatically change the trajectory of your business in some important ways. Your return rate goes down, your return customers go up, your LTV increases, right? So I think investors have kind of gotten wise to it, and also the fact that unlimited growth is not sustainable. On the financing slide, back in 2010, what we like to call it sleepy big TAMs, right? Like these big categories that hadn't been disrupted, from eyewear and on, too many to list. And so it's very easy for an investor to see the arbitrage of attacking the sleepy TAM where there hasn't been innovation. I'm going to go direct to consumer. I'm going to create a better product that resonates with millennials. It's going to use pink colors because I hired Emmett Smith at Gin Lane, and it's going to work. I have a fancy logo, and I have a student guy with an MBA from, Wharton, Harvard, or Stanford. Fast forward, the incumbents are on alert. They've seen the play. They understand it. Margins are getting squeezed. Investors sort of understand that you're not going to have the territory to yourself. Companies have gotten sort of more nimble. Supply chain, same thing. Borrow supply chains work back then. Now there's an understanding like you're just giving away too much margin. So similar to what like SmileCare ultimately had to do, you're eventually going to need to morph into at least controlling your own supply chain. I think marketing is the most important piece that you want to spend a little bit of time on. Again, stating the obvious, but at the end, you could have built an entire business on CAC arbitrage through Facebook and then morphing, along the continuum of new social media platforms. And I think we lost our way a little bit in confusing customer acquisition and kind of low-hanging fruit customer acquisition as the equivalent of building a brand and as the equivalent being marketing. And we lost our way from, that's not storytelling, that's not community. Fast forward, the understanding is that arbitrage is completely gone. And that I think, investors are looking to back a more moderate, sustained, and sustainable level of growth that has as its backbone community, right? And underpinned by real values. One thing that has proven to be true is that DTCs that are fueled by a passionate commitment to a real value that resonates with a certain demographic, those can go that's building a brand. Everlane has built a brand, right? Boll and Branch is building a brand around sustainable supply chains. And I think, the gimmicky stuff is out the window. On a positive note, I would argue that every founder would rather exist in a world where you're not trying to create hyper growth and become prisoners of your own inflated evaluations, that you're trying to create a real community that is connecting over something important that only a DTC could truly achieve. And going back to like what is great about DTC as a launch vertical is that it's hard to imagine how you could develop that community without social media and without the ability to have that one-to-one conversation. Skip technology, but going straight to Amazon. Course back then, this is one of the things that led me to create the course at Harvard. It's like, how is it that you can get an MBA and spend $250,000 and not have litigated the question of to Amazon or not to Amazon? Now, of course, having the class, I heard out it's a little bit harder than easier said than done. But fast forward, especially in a COVID world, Amazon is not even a question of if, it's how, right? And setting aside the unfortunate examples of what they did with the sneakers example. Why am I blanking? But you all know what I'm talking about, basically copying it. And all some of the other examples of basically copying brands. Setting that aside, now more than ever, every investor is going to have to go ahead and every founder is going to have to demonstrate what their strategy is. And then the last piece, retail. I had Katie Hunt from Showfield's joined the class, and there are other competitors that are trying to be the bridge of retail. But whatever is your vision for how you're going to get to retail, I think any investor, in those early stages is now going to want to see that vision forecasted from the very beginning. How are you going to take your product and reach as many people as humanly possible, so that we don't have channel conflict or channel avoidance as the standing in the way of your product scaling. So I don't think I have the perfect solution to retail. I'm very interested in Katie Hunts of the worlds about providing this bridge long term, but I do believe that the need to have your product available far and wide is only going to get more significant, because when I look at some of the trajectory of some of the DTC brands I've backed, no matter what you are, who you are, your customer acquisition out the gate, when you have your early converts is lower, and then you start feeling like, man, we might be the exception that proves the rule. Like, our CAC is hanging in there, and we're first order profitable, and we don't even care about LTV because it's fine. And then I check back in 12 months later, well, CAC is rising. And like, as you kind of peel back the layers and you try to go after more and more customers, and you have mature competitors now competing for the same eyeballs, like, investors are aware of that now, so they want to see a vision from the very beginning. How are you going to morph into retail? In the case of CPG, at what point are you going to say, now I need to be on the shelves, like Lola did at Walmart, or, in the case of Magic Spoon, at Whole Foods? Like, it's not so much when are you going to make the decision, it's how are you going to make the decision. And I think I want to see, show me the quality of your decision making to show me what's the litmus test is, and what inflection point does it now make sense to sort of go into retail. And likewise, if you're a physical product that needs to have your own retail distribution, sort of an Outdoor Voices or Everlane's going to open stores, how are you going to do it? How are you going to make it profitable? What's your strategy? Where are you going to be? Are you going to use a bridge like Showfields because you really just want kind of a pop-up presence, or are you going to have to create your own retail footprint? I think those decisions all need to be made. So I presented this deck to you because it's like a moment in time of January 2020. I think most of it still kind of holds up, and I think we could spend our time in the Q&A saying, okay, what is morphed? What are the specific things coming out of COVID? And I have some ideas to talk about that too. So I'm racing because I want to talk to you about your problems and what you're dealing with. And but I think this stuff is gold. And next slide. So what's my point? Now may not be the time to raise money. I have some caveats and asterisks to this point, but I do think the perfect use of your energy right now is, one, to build that community and tell your story. So any founder out there who, and this is not willing to show their video to me on this presentation, I would ask yourself to get comfortable with telling your story. You have a great product, you have a great story to tell. Like, you need to use this time to get out there. Two, if an investor says they're not fundraising, they're not, which a lot of investors have just hit pause, which is natural human behavior. You should say, I just want to put my story in front of you. I'm not even looking to raise money right now. Like, lower the friction of the interaction so that investors are receptive to hear your story. Because I'll tell you this, I spend most of my time, 90% of my time, dealing with really ugly, unfortunate fact patterns and questions of layoffs, and just like, how are we going to time, and when does walk the line come back in my food businesses, and like on and on and on. When I get a delightful deck from somebody who's not trying to get me to write a check, but paints a picture of the world, of the future of DTCs, like, that brightens my day. And I would argue, especially in the DTC space, like, we represent innovation and hope and like great products, and the fact that innovation never dies no matter what we're going through. So I would argue, use your time to get in front of decision makers, investors, with a frictionless pitch to say, I just want to be on your radar. Like, I'll come back to you when I'm raising. So that's easier said than done for some people, because you do need cash. So if you were looking to raise 2 million before, do a bridge round for 200 from people who really believe in you. Like, anything you could do to buy time. I'm not usually a huge fan of bridge rounds. I think it signals like weakness or bullshit. But right now, I think now I completely arguing the opposite. Bridge round is a great way to get you through this period without getting hammered on terms. Why don't we stop there and we'll get into the dialogue? Can you hear me? I can't hear you.
Yes.
Now I can.
Absolutely. That was great. So we're going to chat a little bit, but also we are looking for your questions so that you can ask Matt about how you can do all these things that he's telling you to do, because they sound really difficult. So use the Q&A function. It's right at the bottom if you can't see it. But Kaylee, I'm actually hoping you would go back to the slide that had 2010, 2020, so that I could kind of walk through it a little bit.
I'm
there were
doing
lots of
product
good things.
placement too for Bluestone Lane, my coffee concept. I just want to make,
Perfect.
just want
No,
to be public.
of course, because New York. Did you read that story about New Yorkers can't live without their coffee? You can't.
I'm in coffee at the right time.
Exactly. Perfect. So while Kaylee pulls that slide up, so here it is. Okay, so this was done. So like Matt was saying, Matt, you taught this course at Harvard with a lot of really amazing people, and it happened pre-COVID, pre-corona, and this 2020 sort of section there is really interesting to me. So now I'm almost going to ask you to add sort of another column to it and say sort of coronavirus time and see if anything here really changes. Because I think some things do and some things don't, right? To your point. So let's get a little like specific here. One is funding fatigue. I mean, funding is essentially, to your point, you're not going to look to fund companies right now, correct?
Yeah, let's talk about funding. I like that, breaking that through. So post COVID, human nature wants to de-risk, right? Like investors are already managing risk all over their portfolio, right? And that's where the majority of the energy. So anything that increases risk is naturally going to be avoided. And when you're a startup and you're painting a picture of how the world you represent risk. So I would say you're starting behind the eight ball. It's just a fact, right? So I would add another column like, startups and especially DTC represent risk. I have an asterisk now though. That was 2 weeks ago. The conventional wisdom is changing a little bit. Hey, interesting how they're seeing all these stories about how DTC businesses are doing phenomenally well, and like how there's an ability now to touch people, and Amazon is now the lifeline for everyone. And I think a window is opening and a door is opening and a receptivity is starting to happen to hearing the story of how a DTC brand has fared during this, and a sensibility that some of these changes might actually be lasting. So I think it's actually evolving and iterating that quickly that I noticed in talking to other investors, there's a curiosity of saying, hey, do you think this trajectory we're seeing is kind of sustainable? And what are you kind of hearing? Does that make sense?
Yeah, it does. And I think you said something earlier, which was, okay, you may not be, even if you know that nobody's really going to give you some money right now for the reasons you just outlined, it doesn't hurt to put yourself in front of them regardless, right? Like this is the time to send the email, tell your story. But there's also, you wrote about this earlier, but there's a risk of being pretty tone deaf. And you've gotten some pretty tone deaf emails in the last few weeks that I know that you detailed.
Let's talk about that.
That you detailed writing about. So how does somebody, in the interest of sort of the action part of this, yes, okay, so there are founders on this call saying, okay, I want to get my story in front of these people, but also I don't want to risk coming off, like to your point, like I have low EQ, because that's what I think is happening with a lot of people.
I think great point, and a hard thing to teach EQ. So I think you almost have to get into tactics and what to avoid, right? So don't try to sell strength. Like everyone, it's okay. It's actually the one time where it's all of us are allowed to be weak and vulnerable, right? Like we are allowed to, just Governor Cuomo talking about him being vulnerable. He apparently wasn't a great dad. He's cats in the cradle, and like we're allowed to be vulnerable. You should be vulnerable with your business. Like, it's such a horrible time. And, we're doing everything we did like everybody else dealing with the challenge. So acknowledge that it's a horrible time. Don't position strength. Don't say things like, hey, I was doing a $500,000 raise and I've got $300,000 soft circle and I'd like to try to squeeze you in, all that nonsense. Like, because nobody's going to buy it. So I guess my point is lead with vulnerability. It's been a really tough time. Unfortunately, I launched my business only 2 months ago. Talk about great timing, but what's interesting is we are finding though that people need our product. Why? And I'm happy to talk to you a little bit more if you're interested, right? Because everyone, especially an investor, keeps one eye open for arbitrage and opportunity, right? It's just natural. Like so if you are a hint of that, like I see emails, when emails are written the right way, I'm like, oh, that is kind of interesting. Like that doesn't make sense, right? But when they're written, when they have that thing, they're trying to sell me like, hey, we're the one few business that's doing great, I just delete.
Absolutely. So James has put in actually a question that's kind of related to this. So given the market dynamics amongst large legacy strategic companies and retailers, how do you evaluate future exit opportunities as part of your investment thesis? And you have to bring up Casper, by the way, in this answer.
Wait, so how do I?
That was just me giving you an addition. How do you evaluate future exit opportunities as part of your investment thesis on the front end, is James's question.
Yeah, that is a really great question. It's really kind of tough. And I think that's where a little bit of the leap of logic has to take place because the world is so unsettled. But if Walmart is your potential acquirer or Procter and Gamble, there's a few ones that I'm not worried about the landscape changing. So, but I'm almost a bad person to ask because I'm never overly worried about exits. I feel like exits take care of themselves. In our deals, we don't put exit clauses because I'm like, well, we'll know when to sell or somebody will buy us. Like it's never. So I'm kind of bad at that. But I think there's certain industries that that DTCs will continue to be the innovation pipeline, probably now more than ever, right? Like that's not going to change. That Walmart's and the Targets and not Target, bad example, but Procter and Gamble are still going to look to acquire DTCs. So I'm a little less worried about it.
So Imran actually had two things, which was related to this. One was the company we're looking for was Allbirds earlier.
Allbirds, I'm sorry. I don't know what I think on that. It's terrible.
It's okay. It's all right.
Probably because I asked like an idiot way back when. And so I don't like to talk about it.
So he has a good point, but then related to this, given the difficult run of exits or near exits, so he mentions Casper, he mentions Smile Direct Club, he mentions sort of the blocked merger with Harry's. What are kind of successful outcomes? So say, how do you think about those successful outcomes?
Okay,
and add on to that. Like if I come to you, I say, okay, well, what should I be presenting to you as a founder or as somebody who's building this to make you get interested?
Okay, so let's go back to I gave it to you on the right hand column. Like let's deconstruct Casper, and I love the guys at Casper. I just in my view, like Casper was solving a problem with potentially the wrong solution, right? Casper's problem was that when I go to buy a mattress, the experience sucks. The problem was I don't ever need to go into a store to buy a mattress. Like I would argue that most people on earth would love to try out a mattress before they bought it because it's full of friction. It gets delivered. I got to return it. Right. So Casper tried to eliminate that problem. Whereas I actually think they did a really good job with their stores. They were like, so looking back, if you look at their business model, they are very 2010, right? A big, Sleepy Tam, although I think there are 185 competitors or some crazy number. And the economics of the orders didn't make any sense. Right? It just didn't make sense. The kind of thing you say, well, we'll make it up in volume, but the more volume you have, the more underwater you are. So I would go back to what I'm saying is the way to avoid Casper type exits and a little less so Smile Direct. I can't perfectly explain Smile Direct, but remember this was all triggered by WeWorks and a reappraisal of like what have we done, right? Mm-hmm. I would argue if you follow the 2020 playbook on the right hand column, you'll have no problem exiting because you'll be a business where your unit economics make sense, where your marketing is rational, where direct to consumer was just your launch vertical, but you had a vision for how to migrate up, through retail and through distribution, and you figured out your Amazon strategy. So I'm 100% convinced that great businesses that are healthy and sound on the right-hand side will have exits and will get funded.
So speaking of people looking for silver linings, Cynthia says she feels like VCs have favored DTC startups, even though they aren't really tech, and they've put copious amounts of money in without traction and founders that don't have domain expertise or even management experience first. Shots fired. Meanwhile, VCs have been demanding so much. Meanwhile, VCs have been demanding so much traction from SaaS companies, even when their founders have proven track records. So her question is this crisis going to make VCs more interested in SaaS cos now and raise the bar for direct-to-consumer companies, which I think is a really good point.
I mean, like a brilliant point. The question in of itself is really smart. The answer is 1,000%, right? That like SaaS has always been a tremendously attractive business model where you can understand the unit economics a lot easier, right? And I mean, so the answer is yes. If I had $1 to spend, it'd be easier to get me to spend the $1 in a SaaS business than it would be in a DTC. So let's just put that off to the case. I think the DTC phenomenon was a little bit driven by the quick unicorn, right? Like it just when it hit, and you look at Hims, right? It's getting $1 billion valuation within a year, and like so I think that fantasy, which sometimes turned into reality, is probably over, right? So that's good. There's been a culling of a herd, ability to bring ourselves back down to earth. But I think what hasn't changed, there is still something special about DTC, and I don't want to throw out the baby with the bathwater, which is why I say it's a launch vertical that enables me to have a one-to-one conversation with the customer instantly about a product they didn't know they needed or weren't willing to talk about. That actually somehow changes the way that product is developed or changes the world, like the way Bollinger Branch did with the supply chain. That couldn't have happened with an old stodgy company, right? That enables you to get traction instantly by creating a community and a conversation around your brand that then resumes your trajectory of traditional distribution channels when the time is right. Those are
Mhm.
unique and very special things. And so I'm always, I don't want to become the cynic that throws out the baby with the bathwater. I think that is interesting, right? Like, and I think there'll always be good companies that are following that trajectory, and there'll
Yeah.
always be sleepy TAMs yet to be disrupted. No one would have thought Magic Spoon would have been, would have gotten traction in a cereal category that's growing like 2%, and yet look what they're doing.
Yeah, absolutely. I'm going to actually move down just a minute before we take some more questions here,
Yeah.
because I think what you said is really interesting here about this 2020 column. Follow me down to the marketing one, and it says arbitrage is over and CAC is expensive. CAC is not that expensive anymore, right? So at least on Facebook and Instagram, I mean, what we're hearing sort of in COVID times, let's call it, sort of while this situation is going on, that we might be getting to a point at which prices on Facebook and Instagram are coming down. So is customer acquisition costs, how would you advise kind of someone to take advantage of something like this
That's a
and
great question.
have their marketing accordingly kind of figured out? Again, thinking again, this is a good time to do other things than fundraise.
That's a great question. So just to break that down, a few points. I'm not 100% sure how CAC has gone down in different places, right? So it's almost like you have to go platform by platform.
Sure.
And therefore, I'm not 100% sure how enduring this phenomenon is. So I'd be a little nervous by going to an investor like, look at this, like we're first order profitable, because the times of COVID will come to an end. But I'm also not sure the premise is even true. Second point, I do know certain areas actually are cheaper, and I'd be looking at them if I were anybody on this call. It's like any kind of podcast sponsorship, anything where sponsorship immediately like dried up and is very hard to get, and it's hard to buy in volume. There are some great assets to pick off that could be 50% discounted that are kind of very effective. Third point, which is more important than points 1 and 2, is that when I look at some of my companies that are doing really well on DTC, they have a strong community component. They have a very passionate product or a sort of high profile founder that they've been using free customer acquisition in the form of content to build up their base. Let me use Milk Bar as an example. Christina Tosi is doing a baking show at 2:00 every day live on Instagram. And the amount that her following has surged has been incredible. And the way that it's affected her CAC is extraordinary. She's probably doing half of her orders are coming from organic purchases without spending a dollar. So my big takeaway coming out of this time, you'll be in a much stronger position as if you can go ahead and build a passionate community around you that you convert down the road, right? Like that is to me the safest place. So when I'm looking to where to put my dollars, I'm looking first and foremost for mission-driven companies that I could imagine people congregating around that brand for a conversation, because I know that that's the word. They'll be more enduring anyway, but I know that it'll be cheaper to convert those customers down the road.
Nick is asking a question. How important is subscription as a service as a percent of total sales, more or less in a post-COVID world?
I think subscription as a service is always fantastic, right? If you can get it. So, it depends. I wouldn't wait to
That's a
do.
big if.
Right. But I was gonna say,
Put the underline under the if.
well, I didn't want to dishearten all the people out there who are like, that's great. I don't have that. So, like, yeah, of course subscription businesses are great, but I don't think the post-COVID world, look, subscription businesses de-risk the investment profile, but I don't think that there's a flight to it necessarily.
Okay. Makes sense. I am curious about this question because it was one I was going to ask too, but let's go back sort of to these companies like Showfields, or in general, just sort of using kind of these bridge physical retail operations, Showfields, there's Beta, Neighborhood Goods, et cetera. And in general, I'm curious about where this ends up. Again, we get past this and things sort of on the path to recovery. Physical retail, people will go back to their stores. Maybe they'll start renegotiating rents, of course. They'll probably not pay the top dollar they were going to pay back in January. But what happens to these companies? Are companies like Showfields, Neighborhood Goods, the future post-COVID-19 as brands look to target customers omni-channel is the question that was asked, and the same one I had.
It's a good question. I mean, I know Katie really well, so I have like some of the inside perspective. But I think a few things are being represented by a Showfields. One is like the business of Showfields itself, and then the service that Showfields is providing for other businesses. I think starting with the service they're providing, there does need to be a bridge. There's a tremendous utility in enabling a company to go ahead and experiment with a physical footprint and figure out what resonates, what moves, so that you don't have to make this massive commitment to fixed retail, right? I think that is actually more valuable in a post-COVID world, right? Because
Hmm.
I think retail is going to be paralyzed and decimated for a long time. It's very, very complicated. So I actually think the show feels in a neighborhood goods type perform more of a service. I think as a business unto itself, I think they represent the need for to reimagine retail as an experience. I
Hmm.
can't pick a winner, but I know that the manifestation of retail as an experience is the winning idea that's going to keep these malls and retail alive. And it's just sort of like obvious. You walk into a show feels like, oh, this is kind of what I want to see and experience, right? This is like, this makes sense. I'm seeing the most contemporary brands. So it's very hard for me to predict the future of retail, but I think retail needs to be reimagined as one giant experience. And the problem is real estate owners, developers, like will only act when it's like too late, right? They tend to, you know what I mean? And I don't know, like if I had a massive resale, I would become neighborhood goods or show fields. Like I would curate my entire, space that way. Like I wouldn't need to get show fields to come in. I'd be show fields, right? I'd make the whole thing curated. I'd make the contracts flexible instead of trying to impose 10-year leases with massive capex up front. I would just be that thing. So
So let's stay on that for a minute, and I think what you just said might get Katie really excited too if you decide to do your own show fields. So how does this sort of change the negotiation and relationship sort of in general with things like negotiating leases, with
oh,
things
that's a
like
great
that?
question.
Because I was talking to Ashley Merrill, who founded Lunia, and she was saying, there were really expensive places that she was looking to talk to back in January. And thank goodness she didn't sign the contract at that point and waited a couple months, because there's no way she's signing that contract at that price. So do we see, and a lot of people are now talking about obviously rent negotiation, and this is all just part of the keeping the cash flow and keeping cash. How does this shake out? Which of these trends sticks once we get past this? And what should, again, founders and companies be thinking about when it comes to the cash there and spending money on leases and long-term rents?
Great questions. So let's just talk about categories of types of business that would ask
Okay.
that question. If your business is inherently brick and mortar, let's say you were kind of in the food space, or you just know that your business involves having multiple units, that I do think this is an opportunity to acquire, a main on main type spaces at terms that have never been available and may never be available again. So if like it is inevitable that you must have that physical footprint of dedicated brick and mortar, then I would be really thinking about playing, offense and trying to not just be paralyzed and then you sort of miss your moment. So, for example, cash is king, right? And like a lot of these, developers and real estate owners are really struggling. So, if you are willing to kind of commit, you can drive some incredible terms. So the first question is it inevitable that I need this retail footprint? Then I'd be looking at, at a main to main. The problem is when does foot traffic return? When does human behavior return, right? So you have to be really careful that you've synthesized all the variables. And so I would be heavily weighted towards like free rent for a year, right? So that I think I have enough time to sort of watch it play out. But for those that aren't sure exactly about their retail strategy, like I don't want to make any commitments. I want to watch and see how this plays out. When I see the head of the CDC saying that we're going to have another wave with flu and corona in
Mhm.
December. Here's one thing, just I've been paying a ton of attention. I read every sort of scientific study that comes out. The one that came out of Harvard about we need to 2022 social distance. I read about Czechoslovakia and Taiwan and kind of just looking at these other countries. I've generally found to be that there's been a body of science that has pretty accurately predicted everything that's going to happen, and the political system is inaccurately politicized science. So just spend your time trying to look at predictions from scientists, and those have proved to be kind of pretty true. And I would argue that unless you're committed to brick and mortar, everyone else should just hit pause and watch.
So relatedly, then Vincent wants to know sort of how will this change how DTC operates in terms of marketing and supply chain? I think supply chain is a really interesting one there. I mean, what are some of the changes this will have, if any, on how people are managing their supply chains? And again, is that something you are going to be looking for if they come to you to partner?
That's interesting. I haven't seen a ton of struggles on supply chain. Interesting enough, I
Okay.
would have thought that would have been something that I would have been dealing with a lot. So I have to park that because I haven't seen it be a problem as much. And I
Okay.
think you'll find that in most food businesses, it really hasn't been an issue for some reason. Like enough of the world is working that it's been generally okay. Back to DCC though, I think DTC is going to have its 2.0 moment in the sun, and that moment is going to happen when people move from fear and paralysis to an opportunity mindset, which is why I'd say to people on this call, just buy yourself time. The number one way I'm going to be evaluating businesses, which is why I'm taking a fresher look now, is I now get to evaluate how you performed and the quality of your decision making in a black swan event that hasn't happened in 100 years. I now get to see everything I want to know about you. I want to see, did you cut back staff, or how did you handle that? And, what were your values, and how'd you pivot your product because your product was off market? And like, I get to like now probe everything I'd want to know in like a 3-month fact pattern that tells me how are you going to weather these situations in the future. So that's what I'm saying. When we come out the other side, it's going to be obvious that like, hey, these businesses rose to the challenge. Their numbers were great. And 12.5% of all transactions were conducted online prior to COVID. And now that number is projected to be 20%, whatever. I don't know, I'm making that up, but I'm sure it's probably accurate. So most of the people on this call are going to have their moment in the sun soon. So buy time and develop their story, develop their community, get in front of people without trying to forge a sale. Because I actually think you're leaving money on the table. Terms you're going to get today are going to be much worse than post-COVID, in my opinion.
So I'm going to get to Travis's question, and then I have one. But what do you think of the alcohol DTC market given COVID? I know I've been using a lot of the alcohol.
What have you been using, actually? What have you...
I mean, we've written about this a lot, but Drizzly has seen obviously a lot of growth. We've seen a lot of ads on and first-time advertisers, like from things like Wink, from grocery delivery, wine delivery, and other delivery like that. So there are a lot of platforms out there, but also it's like the new mattress, right? There's only 20 platforms out there.
Yeah,
so,
I keep trying to sort of separate in my head a little bit, like what are things that were caused by COVID and therefore it might be more vulnerable when COVID's gone versus things that were amplified by COVID and are likely to stay with us. Amazon, in my opinion, is likely to stay with us, that phenomenon.
Right.
Alcohol, I'm an investor in Drizzly, by the way, from the very beginning, like first round or second round, but I'm not 100%. I think people are going to rush back to wanting to go out again and drink again and not sit at home. So I'm not 100% sure there's massive fundamental shifts in DTC alcohol. I'm just not.
Okay.
Could be wrong. Could be totally wrong.
Sounds good. There's a DTC fashion brand, says Wade, who is on the verge of launch. What advice might you have for entering the market?
Wow, the verge of launch. Well, let's put it this way. There's never been a greater time to reach people with your story. So I am biased towards launch, provided you have no expectations on converting, right? So I think if you're close to launching anything that has a strong content element to it, you absolutely should be launched and you should communicate. Just, don't worry about selling too much is the point, right?
DTC fashion is the category, I think.
Yeah. So then DTC but I don't know what the mission statement is. Are we disrupting something? Are we, doing goodwill? Like, I don't, what's the company? Can we ask more questions?
Wade, if you want to tell us more about this company. Yeah, come on, Wade. Okay, we'll wait for Wade to tell us about the launch, because that is interesting. Can I just flip it a little bit? Also, what should founders and companies be requesting and asking for when it comes from their existing investors right now? This is the time that all of this help that was supposed. I think it was something called value add investing. Like, we're not just going to give you money; we're going to give you support. We're going to give you help. We're going to help you with your marketing and give you lots of advice. What should they be asking for? I know help PPP loan applications up.
I love that.
What else?
Great. I have a lot to talk about on this topic. I wrote something. It's on my LinkedIn. It's called Manifest Your Mindset. I've been putting out newsletters every week. So if you want to go a little deeper on this subject, but I wrote an open letter to investors saying, this is what you should be doing in the time of COVID. And I feel passionate about this. Number one, every conversation should start with the question of how can I help you, right? Number two, you should expect your investors to want to pick up any job that you can't. And just to take that a little deeper, when you're an operator, all you could see is like 2 steps in front of you, right? Like, and you're dealing with, God, I have to do layoffs, and that's emotionally hard. And like, what the hell is this PPP? Do I qualify? Like, am I not? Am I under 500? I argue that investors should take things off your plate, that there's an economy of scale for them handling it. And it enables you to stay focused on what's right in front of you. So what do I mean by that? An investor could have 10 concepts, dealing with PPP. they have to get smart on it no matter what. I argue that investors should take PPP off your hands and like any kind of best practices that transcend the day-to-day operations. So my team, we right away, we met within 48 hours of this happening, said, let's become the Red Cross of business, right? That should be our attitude. Like anything that our companies would need that they can't do themselves, we should do it. Third, your investors should not be asking for updated models because like the 1918 pandemic is not exactly a good comp set. So anybody who's like up your, you know what, looking for like, send me an updated model if this doesn't work out, like enough. There needs to be a little bit of that, but most of it at the end of the day needs to be about that. And then the last part is profit is out the window at the moment. The name of the game is survival. Your investors should be on board with you with driving out the runway. They should also understand that now is the time to live your marketing. So if your company is premised on a certain value proposition, certainly socially mission driven, now is a time that's tested, and now is the time that you have to do your best to adhere to it. So you want an investor group that sort of helps, support it. It's a good time to look at your cap table and find out who's in it, who's not. Let me offer a reverse point though. Mm-hmm. Don't roll your eyes when your investor calls and wants to get involved in something that you're like, I don't really need your annoying opinion, because everybody wants to help and feels powerless too. That investor needs to feed their family, and everyone wants to feel useful. So long as we're willing to pick up a shovel and dig a ditch, you know what I mean, and do some tasks that you can't do right now, you should greet them with open arms. One, you're going to need them later, and two, it's human nature. So it's my counterpoint to founders: don't roll your eyes, when people ask to help kind of in the wrong way, or you don't need it. Redirect them, give them the shovel, or give them the hose, whatever you got to do. But anyway, I wrote a whole thing about this that I feel kind of passionate about.
And you should all go read it. Okay, Wade's come back. He is trying to launch a high-end polarized sunglass brand focused on quality, warranty protecting against damages. A nice sunglasses brand. That's the DTC brand.
I would probably wait, Wade. I would probably spend my time getting more organized, and I'd wait a few months. It's high-end. You're reaching a certain, it feels kind of off. I would lay tracks like we talked about, build a community, build out your value story, connect with people who matter, but I probably wouldn't launch.
Okay. Amazing. Great. We're out of time. I did get a last question from an anonymous person. I don't know who it is, but where did you get your sweater, Matt?
That's so funny. Where's Sarah? Sarah, I'm being asked where I got the sweater. Where did I get the sweater? Where? Oh, you're not going to believe it. Are you ready for the big reveal?
Ready.
Macy's. How much was it? This is my life, by the way. $27.
$27 from Macy's. You heard it here first. Amazing. Matt, thank you so much for joining us. I think everybody learned a lot. I certainly did. And it was so nice coming on with you.
I just want to say one more thing, by the way.
Yes.
I know this is a time where everybody's looking for a little bit of life, a little bit of hope. We are looking again at investments with my partner, Jesse Darris. And so if anybody has a deck and they want to send it to, his name is Stephen Reisert on my team. It's SREISERT at rseventures.com. Okay. And ship over your deck.
Amazing. We're going to include that. We'll include that in the email that we'll send out to people after this that are on this. So
thank you.
Do that. So that's great. And thank you for joining us. Thank you, everybody here, for joining us, asking lots of questions. Join us again next Thursday to hear about the future of grocery delivery. And we hope to see you again on another MR Plus Talks.
Thank you, everybody. Take care. Bye.